Good morning, it's Lane Clark here again at Beta2. Today what I wanted to do was talk about a piece of terminology that is often used in the FX arena. And really it's utilised in the whole investment markets, and that's risk on, risk off. What exactly does that mean? Well, quite some years ago, a few years ago, it was really an investment climate that would determine how certain correlations in the FX arena would perform. For instance, if certain assets were doing well, certain correlations would exist in the FX arena. Over the last year or two it has diminished slightly, but sticking to what exactly is risk on, risk off, let me explain. Risk on, very simply, is risk is on the table in the investment markets. So by that, what I mean is investors are willing to take a risk. They will buy equities, they will buy properties, and on the back of that things will perform well. Economic growth is there, people are willing to take a risk, risk on. So what does that mean to the FX arena? Well, very simply, certain correlations exist. In a risk on climate, we traditionally see currencies like Euro, Aussie dollar, Pound, Canadian dollar, New Zealand dollar perform very, very well. Risk is on the table, and these currencies that used to be high-yielding currencies perform well in a climate like that. So therefore, what is risk off? Very simply, it's the inverse. Risk is off the table. People are not willing to take a risk. So a good example of this would be 2008. The credit crunches started to unfold. Risk was definitely off the table. What happened? Okay, well, very simply, as a refresher, equities went down dramatically. Hedge funds underperformed like we hadn't seen in a number of years. Some actually closed down. Property market, UK, worldwide, it seized up. Mortgage market seized up. Banks stopped lending. Risk was definitely off the table. Again though, particular correlations do exist in the FX arena. And in a climate like that, again, I use the word traditionally, it doesn't always happen. US dollar and Japanese yen are two of those currencies that do perform very, very well. And in 2008, yen was actually up 42% against Great British Pound. So therefore, as an FX trader or an FX investor, you have to be very aware of the risk on, risk off pendulum and try to take advantage of that. Therefore, if equities etc. are going down, your portfolio may reflect a dollar and a yen strength bias. And the inverse is true as well. If they're going up, you may look towards what we would term more sort of growth currencies like your Australian dollar, Canadian dollar, and even, like I said, pound and euro, depending on the independent fundamentals in those economies. So as a very, very, very brief synopsis of risk on, risk off, and what it is, and the terminology and why people use it, I hope that helped. Thanks a lot, and have a fantastic day trading.